Meanwhile, Bitcoin hovering around that $30,000 mark after getting a boost from the potential launch of BlackRock's Bitcoin ETF. But our next guest warns that this won't shield the asset from its first U.S. recession. Mike McGlone, Bloomberg Intelligence senior macro strategist, joins us now. Mike, good morning. First off, so tell us about so crypto had been going through what we call a crypto winter, which includes Bitcoin, obviously. But it's seen a bid recently. Why do you say that it is? I mean, this seems like it's temporary, I guess.
Well, Bitcoin bulls hope it's not temporary. The key reason it had this bid recently because the BlackRock application for an ETF. Most people think that means they will be approved in the U.S., but that's still an if statement. It might not happen this year. And the key thing to remember about Bitcoin is when this whole situation started with COVID, it went down with the Nasdaq, went up with all the liquidity. It's gone back down. Now it's gone back up with the stock market. So for it to show divergent strength away from the stock market, I think it has to probably get through this recession, which we all know is coming. If you certainly look at the yield curve, it's a matter of time. And to see if it can show divergent strength with the stock market going down. As the Fed has pointed out, they are not going to be there to cut rates, which probably is bearish for equity markets. Or does Bitcoin outperform on the way up? I look at it as it's got to prove itself. And at 30,000, about 3,100 this weekend, at 31,000 this weekend, I think it's just a little bit too risky here, particularly if we tilt over to that recession that brings most risk assets lower.
Hey, Mike, it's Julie. It is fantastic to see you. So it sounds like you don't think it's going to hold above 30, certainly in the near or even medium term.
Well, I'm much more worried that of the whole tide going out because of this recession and the risk that everybody's priced in for the bullish scenario. The Fed's going to ease, the Fed's going to save us, yet Jerome Powell says he's not going to. You look at the interest rate expectations, there's still priced for higher rates, and we're getting liquidity pools, meaning higher rates in England and Canada and most of the rest of the world. That's just not a good environment for an expanding global economy that's maybe tilting over to recession. People are hoping for, even if we go for recession, the Fed will ease and save these risk assets. The key point is Bitcoin is still very much trading like a risk asset, like the stock market. Now you look at things like gold and treasury bonds, they might be better off. So it's got to prove it. And the best way to prove it is to get through this recession and prove it. Otherwise, it's just a faster version of the stock market, which I think most people are looking for this faster horse in the race to transition to trade more like maybe gold and long bonds. And basically, you have to be bullish the stock market here and expect Bitcoin to outperform. Otherwise, to me, the key risk is the tide goes out and Bitcoin's the fastest horse in the race, and it kind of leads the way.
Mike, so we also know there's been a crypto crackdown, if you will, when you think about Coinbase, Binance. What do you make of the regulatory climate for crypto? It seems to be simmering recently, but that it could just be a back burner thing right now.
It's going to last for a while, but this is a revolutionary technology. And oftentimes that's what humans do when something comes in that they don't understand, which is okay. The key thing about the crackdown, I think, is prudent is we have to purge some of the massive speculation in this space. All revolutionary technologies have massive speculation. I was reading this weekend about RCA, the radio company, went from 3 to 300 and then back down. These things happen. But there's 25,000 cryptos in each purge. And then there's Bitcoin and Ethereum and crypto dollars. That's very significant revolution technology. The key thing is Bitcoin's going so far, so fast, and it still just it's got to prove it's not just going to go up more than the stock market. And that's the key thing that most of our viewers and listeners have not lived through a true stock bear market where it drops 20%, the Fed doesn't save you, and then it drops another 20%. To me, that's the risk in the broad market.
Mike, I want to turn to more traditional commodities now, especially in the back of the news out of Russia over the weekend, where the coup seems to have been averted. We are seeing a little bit of a lift to oil prices, but not that much. But maybe this is a reminder for us, right, that the situation's still happening. The markets have sort of adjusted to this as the status quo, but that can change, right?
Well, it is great to see you, Julie. I glanced down to see you on the screen a little bit. I haven't seen you in a while since working with you at Bloomberg. But crude oil commodities are a bear market. They're down. They were down almost 30% for a little while from the peak, down 20% now on a year-over-year basis. And the key question you have to ask yourself is what's going to stop this and save it? Typically, it takes a long and variable lag, the Federal Reserve easing. What are they doing? They're still tightening. Now, you see what's happening in China. China's leader made a major mistake of his unlimited friendship with Mr. Putin. And what's that doing? Overall, to me, it's tilting the whole world towards recession. China's having a problem with all the data is disappointing. That's the body in motion. You have to ask yourself what stops it. So I see crude oil is more likely to head towards 50, maybe even 40, priced on what's already happened. Natural gas has already done that. Natural gas went from 10 to 2, and now it's bouncing. And I see the whole commodity market in a bear market, and the question is, I don't see anything stopping it. So I think the best commodity might be continue to perform well in the next year or so, is probably gold as we tilt towards recession, and maybe we eventually get a Federal Reserve pivot or ease. But for a commodity bottom in the commodity market, typically we are way too early. Typically, you need to see a lag to easing, and we haven't even started that yet.
But Mike, okay, so you're seeing crude head down to 50 right now. We just put up a chart where crude is sitting near $70 a barrel.
Yep.
You know, I mean, that seems like such a sharp drop from where we are now, and you know, the talk of a recession is starting to kind of be pushed back from a lot of analysts and economists that we speak to. What's the base case for crude heading to $50 a barrel?
So I like to ask what part of an inverted curve, plunging commodities, and the Federal Reserve and most central banks still tightening leads to the recession being over. Right now we're seeing a bounce, but I did make the call for $50 a barrel a long time ago when it was much higher and it was on the way up. But that is the trajectory. The key thing is that's what it always does is commodities always go towards near their cost of production in the long term, in particular when economics get a little dicey. And that's happening right now. $50 is the average cost of production in the U.S. In natural gas, the average cost of production is around $2. That's where the market's bottom. So right now, the key question I like to ask you and our viewers and everybody else is what stops this bear market in crude oil? OPEC's trying to help by cutting supply, but typically what happens when OPEC cuts supply, that happens in bear markets. They're responding to what they see in the macro in a prudent way for a cartel that's trying to boost prices.
Mike, presumably, if indeed there were some sort of resolution to the conflict in Ukraine, some sort of change in leadership in Russia, you could envision a scenario where you would actually have a pretty big increase in oil supply, right? It probably wouldn't happen right away, but would that be the outcome?
Well, that I think that's a good point. First, I would expect grain prices to go lower. They already have because the supply elasticity picked up. Remember, Brazil had a bumper crop last year because of prices. Crude oil would probably collapse. I think it would be very good for the global economic situation that pressure from this war would be alleviated. To have a change in power depends on who comes in and how they do it. But overall, that would be a relief, and it would accelerate the commodity bear market, I think. And that's the key thing to remember is we're in a bear market. What stops it? Typically, you need some major catalyst, and usually it's from a demand side. And usually from a demand side, you need global economic demand pull, and typically you need some help from some Fed and central banks.
Mike, great to see you. Mike McGlone, Bloomberg Intelligence Senior Macro Strategist. Be well. Thanks.